and really work towards addressing these disparities. So the webinar logistics. Your speakers are, I'm Christy Luzar, I'm the Executive Director at the Urban Economic Development Association. And then we have Bethany Sanchez from the Metropolitan Milwaukee Fair Housing Council. Bethany, if you want to say hello.
Hello, everyone.
Yes, and then we have Joanna Jimenez, the Take Root Milwaukee Program Manager. So Joanna, if you want to say hello.
Good morning, everyone. Thanks for being here.
Yes. And logistics, make sure, I think you're all muted on entry. You can use speaker view. We're going to be using slides for most of the webinar. It's a lot of data. But so put any questions or comments in the chat. Joanna will be monitoring that, and we'll jump in. We have a few points throughout the presentation where we can do some discussion and grab things from the chat that way. We'll also be capturing them. So if we don't get to all the questions, we will answer them as best as we can and send them out afterwards. Which means, yes, we will share the recording and the slides, as well as a spreadsheet where all this data kind of goes into. So there's a lot of opportunity for you to look at the information we present today afterwards in more detail. So the agenda today, our first point is really to present the data. There's a lot of information out there related to both economic disparities, but then also mortgage lending. And so we try to pick out a few things, if you will, in this data, unpack it a little bit, and sort of use it as a place to start to think about what we can really do to start addressing the homeownership disparity in our community. Then we're going to discuss the data. So it's a big issue. Again, let's unpack it a bit and think about what it tells us and what that means for us to strategize. And so, how can we really have an impact on these disparities, and what does that look like in the work that we do in community and economic development? Who we are. So I'll have Joanna, if you want to talk a little bit about Take Root Milwaukee.
Sure. Again, Joanna Jimenez, a program manager for Take Root Milwaukee at UEDA. So Take Root Milwaukee has over 50 community organizations, neighborhood groups, housing counseling agencies, realtors and lenders who all come together to promote sustainable homeownership in the city of Milwaukee. And again, it's a program of Take Root Milwaukee. Currently, we have 54 members, actually. So very excited about that. And I look forward to working with maybe some new people that are not part of that.
Yes. And I'll just add that Take Root actually this year celebrated its 10th anniversary. So this is a group that has been working together in this space for over 10 years. So, and then our other kind of group of people where we're partnering is this Milwaukee Civic Response Team that came together in March and April. Really a group of folks, kind of particularly funders and other partners, to kind of work together on how we can address the immediate impacts of COVID-19. And then in May, they formed an economic recovery work group. And so Bethany, I don't know if you want to speak a little bit about that. You have some information here on the focus of what that group is doing.
Sure. Well, Christy and I are leading the subgroup of the economic recovery group that is, like she said, focusing on the disparities between homeownership of African American and Hispanic homeowners and white homeowners. As we'll see in the presentation, the homeownership rate for people of color plummeted precipitously in Milwaukee as well as across the country, but definitely in Milwaukee as a result of the past foreclosure crisis that started around 2008. And actually the level started going down even before then, I think, as people got connected to unhealthy predatory loans, and those loans started to go belly up. The other thing I wanted to say about Take Root Milwaukee is that in addition to the sectors listed here on this slide, philanthropy is part of Take Root Milwaukee. So Greater Milwaukee Foundation and Zilber Foundation are also active members of Take Root Milwaukee, and we certainly welcome other others of all in all sectors to join the group, because together, when we put our heads together and bring our different perspectives and our different neighborhoods and our different industries to the table, we're all stronger. Lamont Davis and I are the chairs, the co-chairs of the, what do we call it now? The Education and Advocacy Work Group, which currently has pivoted back to foreclosure prevention in the face of the pandemic. And so that's a big issue for us, and something that we're going to need to intensify our work on in the coming months and year, probably at least.
Right. And one thing to know about the Economic Recovery Work Group, this is one of 4 areas. And when that group was meeting over the last 6 or 7 months, we realized that what was coming out of the stability of African American and Hispanic homeowners really aligned very strongly with Take Root's work. And so I'm going to go to the next slide. You'll see who we are. This is the group that actually started with the Economic Recovery Work Group. But a lot of these folks are actually already members of Take Root Milwaukee and active there too. And so I want to thank these individuals who are here, who have helped us plan this webinar and think about how we can do this a little bit more deeper and kind of bring this data to the group, to everybody. So the purpose of the data analysis, there's 3 kind of ways we think about this. And like I mentioned earlier, this is something that we've done since 2012 with Take Root Milwaukee, but it is informative. HMDA data, Home Mortgage Disclosure Act data, really is a great tool to think about work and community development. And we can get a sense of what the lending marketplace looks like. And Bethany, I think I was going to have you talk just a couple minutes about HMDA data in particular, because you do
Sure.
a lot more with it than I do.
So as Chrissy said, HMDA, HMDA, stands for Home Mortgage Disclosure Act. And it's a federal law that was enacted, oh gosh, I think it was right around the same time that CRA was enacted, which was 1977. But in any case, it was several decades ago. And it's a law that requires almost all home lenders, lenders that lend in any aspect of the home market, whether it's home purchase or home refinance or home improvement loans, to collect information about the borrowers and submit it to the federal government. And then a lot of that information is required by HMDA law to become public, to be made public. And so, like Christy said, we use it to inform community development. We use it to inform our work around which lenders, which banks, which credit unions, which other mortgage lenders are serving the communities that we serve well, and which ones aren't serving it at all. And in the case of the Community Reinvestment Act, banks, deposit-taking institutions that are banks, are required to actually state what their service area is. And if we take a look at that service area and then we compare the HMDA data for that service area to it, we can tell whether they're living up to their obligations under the Community Reinvestment Act. So we get a sense of what they're doing, who's doing well in terms of serving low and moderate income people, who's doing well in terms of serving people of color. We can look at it in terms of gender, income, not only the income of the borrower, but we can also look at it by the income of the census tract in which the home is located. We can look at the race of the borrower, and then we can look at the racial makeup of the census tract in which the home is located, and cut the information in just a lot of different ways. And it really helps us to inform how banks are doing and serving us. And then we can have those conversations with the banks and other lenders about what they're doing well and what they ought to continue to do, and who's making progress, who's really missing the boat, and help them with some ideas about how they could better serve the community that we are working to serve.
Right. I think this is going to be a lot of data on this webinar, but the point is that this is a way for us to start a conversation, particularly with our financial institutions, about investments that we think need to be made in the community and how they can support some of the community reinvestment act goals. And so, like Bethany just went through, there's a lot of different ways you can look at this data. And so that's why we're calling this a series. So HMDA, what we do today is just one thing that we can do. And so we do a lot of comparison. We look at changes like year to year, where are loans being made and to who. We're doing some comparison between the city and the county. And then we look at the lenders that seem to do particularly well with providing loans to non-white and low to moderate income borrowers. And a lot of this supports the work of what Take Root Milwaukee is doing. One of the things our education and advocacy work group really does is think about how can we promote lending in underserved areas and to borrowers that traditionally have been shut out from credit. And then also, what are some new lenders entering the marketplace that we can engage in our work? So our key questions today are right here on the slide. What do racial disparities look like when it comes to home ownership in Milwaukee? It's pretty grim. So I think we all know that if you're active in the sector, but we'll kind of unpack it a little bit. We'll also look at mortgage lending patterns. It's an interesting time. As much as we are in a recession and the economic conditions right now aren't great, the homeownership market is very active and very busy. We also want to look at who are the top lenders in different categories. And this is where it gets kind of interesting. And you'll see that like when you break out purchase, refinance, cash out refi, and home improvement, the names change. How do our Take Root Milwaukee lenders? We actually look at them as a group, and we look at the loans that they're making in different tracks. So majority, minority census tracts and low to moderate income tracts. And then again, which lenders seem to serve traditionally underserved borrowers, if you will, well. And I'll just encourage you all to please put questions in the chat. Joanna is monitoring them. So, we have a lot of information, but that's probably the best way for us to make sure we address as we go along. What kind of data do we have? There's a lot, but two main sources. One is the economic data by race and ethnicity. We looked at a lot of the, basically from the American Community Survey averages. And we worked with the Department of State Development. Kate Madison there did a really awesome job helping us sort of work out some of the ways we could look at some of the economic data. And a lot of it is segregated or disaggregated by race. Home Mortgage Disclosure Act data, that's the bulk of what we'll be looking at today. And the Metropolitan Milwaukee Fair Housing Council has access to lending patterns database. And you'll see some samples of reports later, but there's a lot of different reports that we can look at. What we do is we take the top 30 lenders in the county and the city, and then we break out the number of loans by these categories. So you see the loan purpose, which is how the HMDA data slices it. And then we look at who, so we look specifically at two kinds of borrowers, and then we look at where in two kinds of tracks. So Bethany talked a little bit, but we do have a slide a little bit more about HMDA. It was 1975, so you were close.
Close.
I know, I always mix the two up. And this is sort of what the requirements of HMDA. We have found it to be a really great tool over the years to just sort of look at the market, what is happening, and then think about what can we do with this and how can we start conversations with our financial institution partners. And so Take Root has actually done this since 2012. So the loan analysis that you'll see, that's something we have done. Then we've been able to look year to year. But the challenge with the economic recovery work group was like, well, can we take that information then and connect it to the economic disparity data? And then what does that tell us and how does that inform our work?
I think we'll talk about it a little bit later, but I just want to say at this point too, just to make sure that everybody's on at the beginning knows that if you have any questions about HMDA data, if you're interested in looking at the data for the neighborhood you serve, or for the city, or for the county, or the MSA, or even Wisconsin as a whole, that I encourage you to contact me, and I can, you know, run some reports for you and slice and dice the information in any way that, you know, to pull out the information that you need for the population that you're curious about serving, or curious about how they are being served.
Yeah, I'll just say too, we have Bethany's contact information at the end of the slide, as well as Joanne and myself. So you can always follow up with each of us, but Bethany's, the lending patterns database is a really awesome tool and allows her to do lots of different things with the information. It's much easier to work with her than trying to do it yourself through the
Oh yeah.
FFIEC or the CFPB, which I did have to do 1 year. We did this analysis and it was no fun. So economic disparities, we're going to go through a few slides related to that American Community Survey data. So our first slide is the homeownership rate. So this is the city and the county. You can see the overall rate of homeownership in each area. And then you see it by race. So as you can see, the gap between white homeowners and Hispanic, Latino, and Black African American is pretty significant. And we'll revisit some of these. This is a good chart that I found in doing some of our, well, I've known about it for years. The National Equity Atlas is a really great tool. And so if you are interested in sort of racial and ethnic disparities and lots of different indicators, I encourage you to check out their website. They do it by geography, and it's really an awesome tool and a great way to start if you are sort of trying to think about how would this maybe inform our work. But this is their slide. This is through, I think, 2017. And you can see, as Bethany alluded to, now this puts people of color all as one category and white. But you can see at 2010, a precipitous drop there, right? So the gap, you know, which had been pretty steady and not changing much, that's not great in and of itself. But, you know, with the Great Recession, there is the gains that had been made really, you know, were lost to some extent. And so when you think about the economic recovery work group, that has been one of the focus, that's really the focus of that group, is to ensure that in this current recession that we don't see drops like that in some of the things, but it is a difficult challenge. This is another economic indicator to think about in terms of disparities. So median household income. And so we break this out. This also we source from another really awesome data tool. If you have not looked at the Milwaukee Health Compass, is also a publicly available great tool, lots of different indicators. So if you're, again, starting out on this or want to check that out, I highly encourage you. It's pretty user-friendly as well. And so median household income is another way to think about, you know, where the disparities lie. And again, you see, we've also taken the median household income and done it as a percentage of white household income. And, you know, Black African Americans in the city, as a median household income, make half about what white households do. And then another sort of economic indicator to think through is also median monthly housing costs. So how much do people pay for their housing? Sorry, I'm like getting lost in my slides. And then we looked at owners and renters. And one of the reasons why it's sort of helpful to think about it is if you look at the monthly housing cost between an owner and a renter in our community, it's actually not that different. It's about $160, I guess, if I'm doing math in my head fairly correctly. And so the gap in terms of somebody changing from a renter to a homeowner may not be as significant as we think it could be, right? There's a lot of other indicators and factors that play into that, but you know, this is another way to sort of think about home ownership. But another thing we also pulled out of the data was the percent of homeowners with high monthly costs. And so HUD defines that as you know, spending about 30% of your monthly income on housing, or if you're doing more than 30%, that means you have a cost burden when it comes to housing. When you think about homeowners, if they are paying more in high monthly costs, that means they may not be able to afford critical repairs or maintenance, or they fall behind on property taxes. And so that's something, you know, home repair and a home improvement, access to credit in that space and grants, that's a huge issue in our community too. And then the last thing we looked at was values and affordability. So This was actually in the city of Milwaukee's 2019 Housing Affordability Report, another great report. I encourage all to look at if you haven't. It has a lot of really great information on these topics, but they sort of thought about what is the median assessed value of an owner occupied unit and who would that be affordable to? And so, we have the median assessed value for the city and the county there. And then there's a calculation that they came up with, sort of looking at, what's the average property taxes for, a house of that value, given current mill rates. And then, at a, let's say an interest rate of 5%. And while that's high, if you think about how low interest rates are, but as you get, like, let's somebody, for example, is getting an FHA product or doesn't have a lot of down payment, they will be paying higher interest. So it's like a good proxy, if you will. But that gives you a sense of, that median value of a home in the city or the county that would be affordable to somebody with an annual household income of $37,000, or for the county, $47,000. So it's another way to think about affordability. So we're going to pause, I guess, briefly here, and just to sort of think through, and this is where I might check in with Joanna to see if there's been anything in the chat. But one thing to consider, and so we're going to be doing a lot of considering in this webinar because it's the easiest way to sort of pause, think about what we're learning, and then maybe what we can do moving forward. So how would we decrease the homeownership disparity gap? When we looked at the chart for Black African Americans, the gap is 28.5%. For Hispanic Latinos, it's 18.7%.
That's the gap between white, those populations and white homeownership.
Correct. Yes, thank you. Not the average, I guess. And then another thing is, what about the income affordability gap? So another way to think about this is, if the average assessed home is affordable to a household income of $37,000 in the city, but the average median income by race, so for Black African Americans, it's $28,612. That is a 22% gap to get to $37,000. So, affordability is another thing. Like, we would want to make sure that if people are buying homes that they can afford. We don't want to see folks in that category of the higher monthly cost and burden sort of a thing. So, we're sort of putting this out there, what we do with that kind of information and how we, let's say, try to, what kind of strategies we can do to sort of address that is another conversation, but it's sort of a way to for us to think about how would we start minimizing these gaps. And so Jessica, I'm going to see if Joanna, I'm going to see if there's been anything in the chat.
What a compliment.
Yeah, well, usually Jessica is monitoring the chats.
Yeah, so we don't have anything yet on the chat or the Q&A. Natasha has had her hand up. I don't know if you're listening, but did you have a question or a comment, or you just like raising your hand?
Yeah. I was going to say, it's really hard for me to see those things when I'm sharing my screen. So if you can, if you do raise your hand, you can put it in the chat. Joanna can help us figure out what we need to do.
I just want to make sure everybody's heard.
Okay, thank you.
All right, thank you.
All right, so now we're going to go into our lending data. And I'll encourage to our other work group members, if as we start going through the loan data, if you see things here, please feel free to drop those in the chat, sort of conclusions you see, at takeaways. So the lending data, Milwaukee County. So what we do is we take the loan numbers, the volume of loans, and we look at originated loans. So not applications. You can look at the application data too. It is actually kind of interesting. In fact, we've done that a few times on accident where we forget to do the sort, but the volume is just higher. And we look at owner occupied only. So we're not looking at any of the other categories in that space. One thing to note, in 2018, HMDA started separating refinances into two categories. So a refinance and then a cash out refi. So somebody refinances their loan, but takes some cash out, that is treated separately and tracked separately now. And so you see here the total volume of loans from 2017 to 2019. We do over 3 years on this chart, and then by category. Interestingly, there's been a 19% increase. So from 2018 to 2019, And then from 27 to 2019, actually it's 28%. So this kind of gets to an active homeownership market, if you will. Just the volume of lending has increased by almost a third in 3 years, or actually really over 2 years. And that really, what that looks like is 5,700 more loans in a year. So that's the difference between the 20,361 and the 16,446. This is really driven by a large increase in refinance loans. So if you combine refinance and cash out refi, you get a 42% increase in refinance loans from 2018 to 2019. So interesting. And this is something that when we've done this over the years, refinance is always a larger part of the category. But home improvement lending has also been increasing. So, and these percent of the totals, you see that that's the total of all the loans. So home improvement is about 7% of all loans made. And you see the difference, for refinance and cash out refi.
And real quickly, I would say that part of the home improvement increase, I think, is directly related to the advocacy of Take Root Milwaukee and the community groups and the CRA coalition and community groups around the city who have really made a good point about the need for home improvement loans and for people to for our lenders to address that need with products that are going to facilitate that work to increase the value of their homes and bring up the neighborhoods.
Right. And a lot of neighborhoods too offer these like matching grant programs. And one of the things that we've learned from them over the years in Take Root is that somebody gets the matching grant, but it gives them a little bit of cushion where they could even, let's say, get a small, home improvement loan to do a larger project, right? You have to think about the leveraging that goes on with some of these resources too. But yeah, I mean, we've been banging that drum, I would say, home improvement loans for many years. It's just a huge need in our community. When you look at loans to non-white borrowers and LMI borrowers, you'll see a 17% increase from 2018 to 2019 for loans to non-white borrowers. And that actually mirrors the trend in all loans. So remember I said the all loans, it was an increase from 18 to 19 was about 19%. So close enough. It's not like a huge gap. And so if you think about it, it's mirroring the trend. Now, obviously, if we would like to make gains in the disparity rate and adjust that, you'd want loans to non-white borrowers to actually be much higher. And then LMI borrowers, it was an increase of 70% from year to year. And so one way to also think about this, so from 2018 to 2019, there was 800 more loans made to people of color, and there were 1,300 more loans made to LMI borrowers. So I know this is a lot. What we're going to do is put these stats that I've been reading off actually on the slide. It's easier. I felt it would be easier for people to look at this slide as I was going through it. So the city is another way to sort of think about this. It's the same information. And interestingly, the city mirrors the trends. So the percentages are very similar. So from 2018 to 2019, all loans, there was a 17% increase. And then over time, it was 25%. So from the county, it was 28% from 17 to 19. Also, this was largely driven by an increase in refinance loans. And so in the city, from 2018 to 2019, there was a 38% increase after actually a slight decrease from 17 to 18, which was kind of interesting. And then home improvement lending also increased at similar rates. So 34% increase and then 8% increase over the 3 years. And again, loans to non-white borrowers, a 16% increase, which also mirrors that trend in all loans, which was 17%. Now the LMI borrowers, there's actually a little bit larger increase here for the city with a little bit higher volume. And for the city, that meant about 800 more loans made to LMI borrowers in a 1-year period. So, again, this sort of, it's just sort of thinking about the trend is overall, we're increasing lending. Oh yeah, here, I forgot I had a slide on that. So again, we're going to take a pause, but our key takeaways when we look at the purpose of loans and kind of the volume and how it's increasing or really not decreasing, but over the years, last 3 years, it's a strong homeownership market, right? And I think if you talk to any of our mortgage lenders and realtors, and our home buying counseling agencies, they've been very, very busy. Refinance activity is a big part of that, as well as improvement loans. One of the things we talked about as a work group is, when you have, now that you can see the cash out refi, you can sort of start thinking about, people have started making some gains back in equity, and maybe they're using that to maybe do home improvement or do other things. Maybe they need the cash, right? So you can sort of think about the number of people doing a cash out refi, and what does that mean in terms of both the market and what people might be, their financial needs might be too. So there's a lot of ways you can think about this data and what it might tell you.
In terms of those last two bullet points, loans to non-white, but these would have to increase, I just want to really emphasize that it's good that the loans to the people of color and low and moderate income borrowers are increasing at this basically the same rate as the loans to white borrowers. However, there's still the numbers in those categories as that last part in italics says, there's still disparities, and there's definitely a lot of work to do there. I mean, the good news is that everybody, all populations that we're looking at seem to be getting more and more loans. So good on that. but we still have a lot more work to make up for the disparities and to get to equity.
Right.
So we do have a few questions.
All right.
All right. So first, going back to the income slides, Erica asked, do we predict any impact to average medium income with some employers moving to $15 an hour, or is it not significant enough for impact? For example, Freighter, Aurora, and some other healthcare systems are moving their entry-level pay to $15 an hour by 2021.
That I cannot answer right now. And I think if there's anybody on our panelists who might have a sense, but one thing that does bring to mind is we want to make this a series. And so one of the things we could do is do a session specifically thinking about what it would take, what it looks like to actually increase median household income. And so I think that's a great way to think about it. Like, I think the fight for 15, right? When you think about over the last few years. So, we are still, our state follows the federal minimum wage. So that is under $10 an hour. What would it look like if we had more of our, more people in this community have access to even $15 an hour, and how that could impact median household income? So I'm going to write that down, because while I can't answer the question right now, I think that's something we could try to answer in a future session, and engage some other of our partners. So, and I will add, this is really great. This is sort of the things we were hoping would happen in this webinar, because we wanted to sort of think about what else could we be doing in terms of this data, what is a different way to look at it, and how would that lead to action? And so does that mean more advocacy around wages and employment, right? I mean, that might be a potential end game, which if we're working in the homeownership space right now, that might not be our traditional, but so I will write that down as our next steps. Okay.
So Anne Van Dunk, hi Anne. She is asking about affordability. Does anyone collect data for affordability? And then she goes on to say, is affordable mortgage data less than 30% collected at the time of origination or close? Is there a way to filter that data to show those numbers alongside the others?
Bethany, do you have any insight on that? Or even...
I'm a little confused by the question, but the HMDA data doesn't show, it shows income categories. It shows low income, moderate income, median income, and upper income. It's not super specific within those, it doesn't delineate within those categories. And those income, those income levels are by MSA, I believe.
Right. I think the other way, when you think about it, it's like the average, you'd either have to go into where you work with a lender who could, where you analyze like actual loans themselves and mirror up. And this is what the home buyer counseling agencies really do too. Like they really work with someone to make sure that they don't get a loan that's not affordable. But it might be something for us to think about too, what's available, whether it's via the Census and American Community Survey data that is done, some of the housing related things, and sort of unpack that piece a little bit. But because, and Bethany will talk a little bit about this, but as we get into some of the other data information, but the other way we can start thinking about is subprime activity. And so when you talk about affordability, subprime activity is another sort of proxy to think about. Is that increasing, and are we making sure that people have affordable mortgages and things like that? So again, can't answer that question now, but are there any other questions?
And if you want to have a follow-up question, let me know or put it in the chat. Okay, so a few more. Are mortgage lenders not lending to people of color, or are people of color not applying for home loans due to false perception that home ownership is not affordable or obtainable? Or is it both? That's from Kermaya.
Okay. I think it's both.
Yeah. Yeah.
I think it's both, absolutely. And that's one of, I think, our big tasks as Take Root Milwaukee and as a community, is to help renters who are paying high rents and being diligent about it and able to handle it, but not getting anywhere in terms of building their wealth. Our task is to help them to understand that, hey, if you can access a down payment loan, or if maybe you even have some money socked away that you could use it as a down payment, you could get into home ownership and maybe even reduce your housing costs and build wealth at the same time.
Right. I think also that's a conversation that we've been having within Take Root for a long time. Every time we've had a home ownership fair, where we have conversations with people, I know a lot of us, you talk to somebody and they're like, I'm here to get information, but I have bad credit. And then you're like, well, have you looked at your credit? No, I know that Marquita at UEDA, who's been a member and working with us for a long time, has talked about this too. Like a lot of what it is just having conversations with people and helping them see that it's possible. So there's definitely that too. There is the definite challenges around access to credit and people's financials, but it's also this mental hurdle of, yes, homeownership is something that I can do. And so at Take Root, we think a lot about what kind of support can we provide to people who are interested in buying in homes or not sure if it's for them, or renters in our community, and have those conversations and sort of make sure they're connected to resources that can help them make that journey. So,
the other side of that both answer is that many of the lenders many of the lenders have historically not served people of color well, or low and moderate income people well, or communities of color well. And I think that that's starting to change with some of them, but with some of them, they've got a lot of work to do. And we, the Fair Housing Council and Take Root Milwaukee, collectively are here to help lenders to understand why it's important to them, why it's important to our community, why it's important to the overall economy. Not to mention the individual families, to reach out to all sectors of the community. I mean, that's what the law says, but you need to actively market, and you need to connect with the people, and you need to have, in many cases, it's really helpful if you have a branch in that neighborhood, or there's lots of different ways, and we'll talk about that a little bit more later in the
So to that comment, there's a question that says, what is behind the gains in mortgages to the households of color? That's from Kate Wolf.
I think it's both. Back to the both answer. I think that people of color are starting to figure out that they can become homeowners, and the city has some new products. Certainly WEDA's got some new products, fabulous product that combines home rehab with a mortgage.
Mhm.
And so those are all helpful. You know, some lenders are really stepping up in terms of their marketing and all different ways of reaching out to that market. And you know, it's working.
Yeah.
You know, it's starting to work, put it that way. It's been there is an increase, and we need to amplify it.
Right.
So Lisa Williams put in the chat a comment about community advocates and Public Policy Institute. They developed pathways out of poverty package of policies that will lift a certain percentage of Wisconsin population out of poverty. This includes wage and income supports.
Okay.
I guess it's informational.
Yeah.
Are you monitoring the impact of COVID on homeownership?
I would not say we're monitoring, but the group has talked actively, and we'll actually talk about that a little later as like other considerations. Joanna, I think you can speak to that specifically too. So when we get to later in the presentation, we'll talk a little bit about that. The interesting thing is in the middle of COVID, the homeownership market is very active and strong right now.
Yeah.
So for people who have the resources, they are out there buying homes.
Right. And then there's a lot of people that are hard hit because of COVID, and their underlying health conditions are often related to the neighborhoods in which they live that were historically redlined, and all of the effects of that historic redlining that has now come to roost in yet another way with COVID-19.
Yeah.
And just real quick, NCRC put out a report, the National Community Reinvestment Coalition put out a report in September that links, they actually worked with the UW, it's a national report with lots of results in different cities, including Milwaukee, and they collaborated with the UWM School of Health to look at the connection between historic redlining and COVID.
Yeah, it's a very, so there's some of these things we can include as links to, but it's a really interesting report too. But yes, I think everybody is thinking about it, but in terms of monitoring, it's sort of difficult to sort of say like, it's almost so early days, like what, like, for example, when we do the HMDA data analysis in a year, like what would that actually look like?
Yeah, right. So Irma's made some comments, you know, that I completely agree with. You know, this could be a topic for a roundtable that might be led by a homebuyer counseling agency to share information from their programs, their customer profile, etc. She says that this could speak to who they serve and gaps in product availability, resources to expand access for others. So yes, I agree with that, definitely.
We're racking up a good list of new topics.
Absolutely. All right, so 2 more questions. Is there also any preservation around Milwaukee's housing stock in some of the distressed areas?
I will say that there's always a component to that. And I know like we have a couple folks like Maria Prioletta from the city, maybe she could pop something in the chat. A lot of the city of Milwaukee's resources that they get through HUD go to actually home repair and preservation type activities, if you will. We just have older housing stock. There's actually some really great information, that affordability report I mentioned too about that and how that impacts, but that is one of the reasons why for many years, the members of Take Root, we are always talking with our lender members about home improvement loans. Our neighborhood members are very active in getting grant programs for folks. It's just a huge need. And so when you think about preservation, is really about home maintenance, but also making sure that people have resources if they can't pay their property taxes, and then the preservation of affordability. So the city's anti-displacement study and fund kind of speaks to that too. So I would say, yes, there's active work in that space, even as complex as that can be. Yeah.
Yep. So Maria reiterated that, you know, the city have a number of programs um, to assist homeowners making essential repairs to their homes.
But there's not enough resources, as Joanna can attest, because that's one of the main topics we get on our Take Root hotline.
Yeah. Um, Benjamin Sanchez, also from the city, asked, does the data being presented today take into consideration Rocket Mortgage lending and other sources of cell phone application-based lending?
Yes, so the new level of requirement for who has to report HMDA data, which is the data from which we've drawn our numbers for today's presentation, are in 100. They've gone, as of July of 2020, they've gone to 100. It used to be 25. So actually these show any lender that makes over 25 home loans in the geography within the past 2 years.
Right. And we're gonna actually get into now who you'll see, but lots of mortgage companies that show up in like the top 30, if you will. And when you get the report, and sometimes their volume isn't as such to like warrant, let's say, being highlighted in this presentation, but the reports that Bethany can pull from lending patterns into the requirements that are made for those lenders to be able to submit that data are getting better, right? So, okay. So I think we're going to move on now to who. Wait, I gotta click on my slides. So we also then pull out who are the top lenders, and this is by volume. So this slide shows you in the county and the city all loans. So that is all purchase, refinance, cash out refi, home improvement, and then there's like this other category in the HMDA, which is kind of a catch-all. Again, these are originated loans. So not applications, but loans actually made, and they're owner occupied. And so you see the top 10 for the city and the county looks pretty much the same, you know, just a little different order, I guess. So it kind of gives you a sense of, you know, like who maybe has a stronger presence in the city, if you will. United Shore Financial Services is new this year. So they were not in the top 10. That is a mortgage company. And credit unions have actually made more gains in the market in the last number of years. So like I said, Take Root has been doing this since 2012. And as the person who updates these charts every year, I can just tell you that I'm putting more credit unions in and they're going higher up. And then Landmark has been at the top for a number of years, but the other credit unions you see there have also increased their presence. Milwaukee County. So then we also break out the top 10 in each category. And this is where it starts to get kind of interesting. And you'll see this as we go through a few more slides. You know, you can start thinking about these lenders in a different context then, and sort of like who, so for example, there are some lenders that show up in the top 30 even for some categories, but their overall volume of loans doesn't actually warrant them being in the top 30 altogether, but they just mostly refinance, you know, that's what they do. But again, you'll see in the county who are the top 10, and you'll see some new names. So you see a couple more mortgage company folks, you see the Bank of England, who I still am not exactly sure who that is. A lot of every year I'm like, who's that? So Wisconsin Mortgage Corporation, I believe, is that, I do every year I ask this, I think it's at MGI.
That's Shore West.
Okay, Shore West, that's right. Like it's some company. So they, you know, really are helping to process and originate loans for home purchase. And most mortgage companies, a regulatory note, they're regulated by HUD, not a financial regulator like the FDIC or OCC. So, you know, that's also when you start thinking about kind of what the requirements are and who can make loans. I mean, this was something we saw in the aftermath of the Great Recession. All right, City of Milwaukee. So again, the top 4 in these categories actually match the county pretty exactly. So Landmark, Educators, Associated up there in home purchase, this matches this exactly. The bottom 6 is where it gets a little bit more interesting from a city perspective. So you can sort of, again, sort out lenders that might be more active in the city. And, that's where you see Marine comes in, and I don't know, they'd have like a really specific product that, it's actually, I think it's for acquire rehab. Is that right, Bethany?
That's my understanding.
Yeah. So you'll also see them on our chart. There's a spreadsheet that shows they make higher, like it's considered a subprime or a HEPA loan, but that's because it's designed specifically for a certain purpose. So we're aware of that, but it's again, like, you see somebody, you're like, why are they high in this category? What kind of products do they have? Should we be looking at them closer? So, and then Quicken Loans you see has been in the top 10. All right. So, again, the takeaways for this is that credit unions have made more gains in the market as you start to sort by loan purpose. And we will send out the spreadsheet that we create from these reports. So Bethany, the reports she has are very detailed. And what we do is just pull out information and put it in this more summary kind of table. It's a top 30. And so we will send that out, and you can play with it. You can sort it and sort of see who does this, but you'll see new companies like A+ Mortgage, Diamond Residential, cash out refi and home improvement in particular. So this is what I was talking about earlier. In the top 30, when I was doing that, their loan numbers, overall, they actually didn't have enough loan volume to make it into the top 30. But when you look at the cash out refi report, they're in the top 30, like top 25. And so I just listed these names because one of the things that we've been thinking about at Take Root, in particular for home improvement, you see a lot of people getting loans from Home Loan Investment Bank, South Central, TCF. These are all members, or particularly the lenders, the financial institutions. They're not members of Take Root, but we do have relationships with some of them. And so it might be a good list to work from to find out, do they have a specific product? Is there something that they offer in that space that people find that's really helpful? It's a way, again, to start opening the door to these conversations with financial institutions. And, think about, maybe they have a product that meets the need, and so we should be talking to them.
So in addition to maybe they have a good product, which is definitely something we want to check.
That's the optimistic version.
Right. Well, and also they're probably doing a better job of reaching out to people that are in need of or could benefit from a refinance. And so that's something else for our more mainstream lenders to think about is, you can grab some more of that market share and make some more money for your institution and serve people better if you, as a more locally based lender, do that. Because a lot of these subprime lenders are from other parts of the country. I was looking up some of them and it's like, wow, I never heard of that one. What's that about? And, they're from Birmingham or just Arizona, California. So let's not, let's eat our own lunch.
Yeah. Okay, so now we're going to go into top lenders to non-white borrowers. And so you see here the county and the city next to each other. And the other way we thought about this differently is not just the number of loans, so the volume, but also the share. So out of all their loans made, what is the percentage of loans out of all loans that they are making to non-white borrowers? And we did this also for LMI borrowers. And so again, when you look at volume versus share in the county, the list shifts a little bit, right? Like, again, Marine's at the top because they have this product where they're working with people who I think this also might have some credit issues, if I'm remembering. I can't, we talked about it before. But, it's also useful to think about, how are these lenders actually reaching more of these borrowers? And is it, because of the product? Is it the outreach that they do? Are they really working with these folks closely? We see a lot of new names here too. So the list again shifts in the top 30 when you start looking at share. These were all near the bottom, if you will, because their volume of loan wasn't much, but the share actually put them up. So you see Cross Country Mortgage, Cardinal Financial. And so Bethany, I don't know if you want to talk a little bit about some, you saw this list when we did when I sent you the initial slide, and you were like, huh, who are
Yeah,
these?
so that I started looking up. It's like, who is CMG Mortgage? Well, they're based in Sacramento, but they do most of their business in Nashville. Um, and Loan Depot is based in Dover, Delaware, but they do most of their business in Phoenix. Diamond Residential is based in Lake Forest, Illinois. Diamond Residential, 29% of their loans are subprime loans. Loan Depot, 10% are subprime loans. What's another one? Cross Country Mortgage. They're based in Delaware too. 19.4% of their loans overall, not necessarily in Milwaukee, but overall are subprime loans. So we need to look at those. One thing that we don't know from HMDA data is, well, there's subprime loans, and then there's loans with a HOPA indicator, which means that they're even higher priced than some subprime loans in terms of the interest rate, and they might have some other features in terms of closing costs and other loan features that. So we can tell a little bit from that data starting in 2018. Look at that for each of these individual lenders and how they're, whether they're appropriately giving people subprime loans or not, and even the appropriately giving them HOPA loans or not is not something that we can determine from looking at the HMDA data. It's only something we can determine if we get a bunch of complaints and there's an ability to launch an investigation. So just want to put it out there that the Fair Housing Council is definitely interested in hearing about people who feel like maybe they were taken advantage of in the housing market because of their race or their gender or their disability or their family status or any one of the protected classes that are protected by fair housing law.
Right.
So,
and I just was looking in the chat and I saw Lynette McNeely, she had a sort of a comment about the data seems to expose some level of redlining. And so actually we'll talk about this. That's, I think, going to be our next roundtable. There's a series of reports that we can do in the HMDA that looks at lending disparities to borrower along by looking at borrowers in particular and application data. So that's sort of the next chunk. We actually thought to try to include it in this webinar, but we knew it would be like a 3-hour webinar. So I know none of you want to do that. But again, you do this data analysis and you say, okay, who's in the top 30, who's in the top 10 list? Now let's look at it by share. And then you start getting a group of names that you can kind of be like, well, who are those folks? And should we look at subprime activity and think about, is that something that's going on? Are people being targeted, right? Or some prime products have a place in the market, right? But the goal is to make sure that people who use those products understand that the terms and, the consequences and the conditions of having that kind of a product, right?
Exactly.
Okay, so we're going to go to the LMI borrower slide, but again, we did the same sort of analysis, so volume and share. You'll see a lot of the same names, and so again, it's this sort of thinking about who's on this list. You'll see the order might be a little bit different, but just kind of what more could we learn about some of these groups? Could we reach out to them, particularly if they have a local presence? There's some banks, like Tri-City that, we can start sort of maybe having a conversation with and saying, hey, would you like to be involved in what we're doing and work with us, right? Okay, so, kind of the takeaways from that part of the analysis is like, let's look at not just the volume, but also the share. And so why do some of these borrowers have a higher share of their loans going to non-white or LMI borrowers? And, what could that be? And then also like the differences in terms of who was more active in the city. LoanDepot.com, I realized when I was doing that, was not in the county top 10. So they are actually more active in the city. And so again, we may want to take a closer look at some of these, the lenders in the context of subprime activity, which has been very low for a number of years, but the market changes, products come out. And so, we still have to monitor that and think about, that was the lesson from the last, the Great Recession, the housing bubble, was that subprime activity was very, very active. There was some advocacy going on for some of these products, but at the end of the day, the big lesson was like, we really need to keep a closer eye on what those products might be doing to the housing market and to people's financial lives. Are there any, I guess I'll stop to see if there's any other questions, Joanna, or are we?
Yeah, Ben wants to know, well, he made a comment. Some of these unknown financial institutions have a mobile accessible feature that makes lending quicker for a borrower.
Yes.
Yeah, technology is really helping things along, I guess.
Yes. I mean, I don't know about you all, but I would have I'd be a little weirded out about applying for a mortgage on my phone, but if I didn't have a computer, I guess I would, right? But I think that's a great thing to think about if we were going to do, we talked about maybe, we'll see this near the end, but like another roundtable, like talking with some of our lenders in particular around like best practices. And I think mobile accessibility and things like that might be part of that conversation. But the easier it is to just apply for something without maybe having a conversation or thinking through the consequences or the terms or conditions, that also means it may be easier to get into a product or a situation that may not be, at the end of the day, good for someone financially, right?
Yep, good point.
Big decisions you're making. So then the last bit of analysis we do with the HMDA, we actually look at our Take Root Milwaukee lender members and their activity in the city. And we actually look at the number of loans that they make in LMI and what we call majority minority tracts. So census tracts that have a majority of minority people living in them, I guess. And so, in the previous slides, you saw we would star the members, and you see a lot of the Take Root. We have 12 lender members, and a lot of them are very active, in the places where we want them to be, like why we work with them, right? And so the highlights on this, and I'll show a comparison, but, in 2019, they originated nearly a quarter of the loans in LMI tracts in the city, as well as the majority minority tracts. And so these were slightly less than the previous year, but the one reason we do this is as a group, they usually outperform all lenders in terms of reaching these underserved markets. It used to be by a lot more. So it just tells you some of these other lenders are making gains, if you will, and these kinds of, and by geography, if you will. I mean, we could do this by borrower too, maybe. But you see here, the list of the Take Root members and the total number of loans for all lenders. And then we total up the Take Root lender loans and think about how much is that of a share, in terms of number made and tracks. And so, this is, something that's helpful because it's like, we want to, the kind of, I guess, promise of being a member of Take Root as a lender is that we're helping them reach these really important communities that they, as a, under their CRA application should be meeting anyways, right? But we're a partner in that effort. So, so we're gonna quickly now recap what have we learned, and then start thinking about what do we do next, right? So I'm gonna make sure I have my right notes and slides here. So overall, mortgage lending has increased, right? So we, see that from 2017 to 18 to 19. Refinancing activity is one of the larger significant reasons why. The county and city show similarity in their trends and like who is actually lending, but there are differences. And lending to non-white and LMI borrowers is keeping pace with the rate of increase, but as we talked about, that's not good enough, really.
Yeah.
So out of our top 10, and then the top 30 list, which we'll send, I'll show you a sample of that at the end. Who are the most active? Credit unions, obviously, our Take Root members show up on a lot of these top 10 lists, and then these mortgage companies that we may not be all that familiar with, but they are also really active. Who is the largest share that goes to non-white and LMI borrowers? Some we know, and a number that we don't, right? So again, credit unions also are very active in reaching these borrowers, as well as mortgage companies. And then geography is also another way to consider this lending activity, because there is a lot of overlap if you think about underserved, whether it's borrowers or areas. But that is the impact of redlining, geography. Certain loans weren't being made in certain geographies for a long time. And so there was a lack of investment. So geography is also something we want to think about. And then the last thing is, should we be looking at subprime activity more closely? So we'll stop here and just sort of see if there are any questions before we move into the more sort of other considerations and strategy type.
Yes, so Lisa Williams wants to know, Bethany mentioned that individuals can report lenders for possible unfair lending practices. Is that information made public? Are there any credit union members of TRM? Not yet. I can answer that question, but we are working.
You're working on it.
Yeah, to build those relationships with credit unions. But Bethany, is there?
So the complaints that are made to the Fair Housing Council are confidential. The only time it would be made public is if it actually went to, if we were able to help the complainant demonstrate actual breaking of the law, actual discrimination, breaking the fair housing law, which unfortunately is really hard to prove. But if we get a number of complaints about the same lender, that would make it easier to prove. So anyway, the making it public part would only happen if it was taken to the authorities, and the result of that complaint and what happened out with whatever happened with HUD or the Equal Rights Division at the state. Sometimes those resolutions are made public as part of the resolution, and sometimes the companies will agree to something that is even larger and do more restitution if it's kept private. And we at the Fair Housing Council don't have any control over that. But so sometimes it's made public and sometimes it's not. So for example, in 2016, it became public that there was a settlement that Associated Bank made with HUD for discrimination in the home lending market, and that was certainly public. And they have, since 2016, they've actually upped their game, and they're now at some of the lists in terms of home purchase loans in the city and county of Milwaukee. So that's just one example.
Right. Okay. Anything else, Joanna?
No, I don't see anything else right now.
Okay. So we're going to kind of go back and think about let's revisit our economic disparities and affordability slides, right? So again, where we start is really, how can we just decrease this home ownership disparity gap? And then what would it take to close the income affordability gap? And so, we looked at a lot of these lending data and who's making loans and how we're reaching certain kinds of borrowers and areas, and what does that activity look like, right? How do we then connect this back to the homeownership disparities and the strategies, right? And income affordability. And I really appreciate the comments that have been made so far and the questions in the chat, because this gives us some really great ways to sort of go a little bit deeper and think about, what does that look like on the ground, short of just like getting people in the doors of, let's say, a home buyer counseling agency, or, that kind of a thing. Like, there are a lot of different ways that we could be, looking at this a little bit more deeper. And so some of the other considerations along with that are, we've talked about this throughout the presentation, is what do we think is driving lending activity right now? The current home ownership market is very strong. We have low interest rates. And then what also could be affecting people's ability to buy a home? And so you see a number of categories, and these are things we haven't gotten into yet. So COVID-19 implications, we talked a little bit about that. A lot of people are home improvement, try and getting a contractor right now. Like, people are in their homes all the time, right? I mean, there's some really different and interesting ways that this is playing out in this space. The income gap, credit scoring and how that works, household debt. We were actually trying to see if we could find anywhere where people are tracking household debt, average household debt by race, lack of savings. So I don't know, Joanna, if you want to add a little bit, particularly about the market here, or anybody can drop in the chat too, like, just things we should be thinking of.
Yeah, definitely. I know from my personal experience being a real estate agent, that people during this pandemic, just kind of the light bulb went off that, maybe it's time to really consider becoming a homeowner. It's something that they've always dreamed about or thought about. They're worried about their credit and savings and things like that. But being, confined, because of the pandemic, kind of made people just wake up and say, you know what, like, I want my family to have a better living space, or maybe they just need a safer living space, or again, just motivation to just become homeowners. And so a lot of people are coming out, and they've been going to the home counseling agencies. They all reported an uptick in people coming to apply, people wanting to get their credit in order, their savings in order, and just trying to get pre-approved. And the lenders will also say that yes, they're extremely busy. I work with Associated Bank a lot, and they're very busy.
It takes
It's a
like
good
closer
thing.
to 60 days to close a loan right now.
Yes, yes. So, but the problem is that there isn't enough inventory, and so people are literally competing against each other to buy homes. We're sort of in this situation where it comes down to the appraisal. If the house appraises, great, everybody's happy. If it doesn't, and then there's either more negotiation to happen, or the deal falls apart. Some buyers are able to make up that difference if the situation is right, but not everybody, right? And so the push is to get more people to put their houses on the market, but maybe people don't want to sell their houses, right? Because they're comfortable or whatever the case may be. But I definitely think that people are motivated. Lenders are working super hard, to get people into homes, um, and definitely people are looking into their credit.
I would say another thing that affects people's ability to buy a home, especially if you have a limited income. I ran into this when we bought our house, is that we were outbid, and this was now a number of years ago, but I know we're in that situation again where homes are going for more than the original asking price just because it's a bidding war. And if you don't have the ability to outbid somebody, that's an issue.
Yeah.
Sellers are being very strategic, about pricing and to drive up the bidding, right? But I mean, again, if the market's not going to sustain it, then it's really like a waste of time, right? But yeah.
Yeah, and that's where even the appraisal issue, and I was just thinking I might add some things to this list before we send them out.
Mm-hmm.
If you are being outbid or you're putting in a higher bid, but then the appraisal doesn't work out where you can get the financing, and can you make up that difference? Like Joanna kind of alluded to that, but that's really what it means at the end of the day, is that the deal could fall apart because they just don't have the financial then to make that, offer or bid work.
Right. And to Lisa Williams' point, she just made a question. Have you seen indications that people have the ability to buy a home but choose not to do so for rational reasons? Absolutely. Yeah. You know, it's just not feasible for everybody, or people are intimidated, or it's not for everybody. Some people just choose not to have that responsibility upon themselves, or are comfortable where they are. But yeah, maybe they don't have a stable enough job, that they think they can afford it, right? But maybe they're afraid, because of COVID, or any other kind of insecurity in their job. So it could be
Right.
various reasons.
Yep.
See you later, Irma. Thank you for joining us.
Okay, so we also have a slide on a little bit of like what we know works. So lenders that serve underserved borrowers, I hate repeating words, but it was the easiest way to say it. When they do this well, is, this is something that a lot of the lenders might be nodding their heads on this call, but as well as the folks that work in homeownership, promote and use down payment assistance. So, as we were talking about, like people might have a steady job, but given that we have lower wages or median household income, they may not be able to save a lot, right? So down payment assistance, saving for a down payment is really hard for folks. And so if there's down payment assistance out there, that is a great way to sort of get people in the door. That's the carrot, if you will, but then it also helps, you can add in that financial education piece and help prepare them for homeownership, right? People just come out of that process more prepared. They also offer what they call portfolio products. So things that are targeted. So whether it's home improvement or a product that is specifically geared to meet the low to moderate income market. They support our homebuyer educators. That's a pipeline, right, of folks who, and right now in our community, down payment assistance flows through our home buying counseling agencies. They're the nonprofits that can deploy those grants. And so that helps create a strong partnership with lenders and those agencies. The other great best practice is they dedicate a team to serving these borrowers. Lenders that have chosen to, and it's not just their CRA officer, they actually have lenders that are focused on these markets. They generally get better returns. And so you see that in the data, you see that in the loans. And then they partner with trusted community-based organizations. And that gets to some of our conversation earlier around people maybe don't trust banks, but if they meet the banker at the neighborhood fair, and talk to them, and, there's a level of trust that goes along with that. And so those kinds of activities are really important. That's a lot of what our work at Take Root is actually focused on, is helping those, our financial institution members build relationships with our community partner members. It's just a really critical piece of how this, we kind of chip away at this, if you will. This is a little bit of like, this is one person at a time kind of a thing, but it does at the end of the day make a difference. And then access to products like credit builder accounts and IDA match savings. We don't have a lot of those programs anymore in our community because the federal government match went away years ago. But credit builder accounts are also really great tools. And, and for bankers, it's not just about maybe the mortgage loan, but it's the opportunity for people who maybe don't have a lot of credit. They're working with a counseling agency, credit counseling, or the home buying counseling agency. It's a way for them to build some credit and put them in a good position for pre-approval, along with that financial education that goes. So I don't know if anybody wants to add anything, Bethany or Joanna, before I go on to the last sort of set of, we're like nearing the end, folks.
So just to put a finer point on the partnering with homebuyer educators and other trusted community-based organizations, I think that's one of the beauties of Take Root Milwaukee and lenders' participation in Take Root Milwaukee. Don't just become a member. I mean, we definitely want you to become a member and pay your dues and fill out the form and get vetted and approved. But the benefit is going to come when you attend the meetings, you attend the quarterly meetings, you attend the roundtables, you attend the work group meetings, and you really get to know the folks in the community, and in formal and maybe even more so in informal conversations, you get to understand what the needs of the communities are that our other partners serve, and really have a deeper understanding of how you can do a better job of serving them as well.
Right. So kind of to round out, because I know this has been a lot of data and information, we kind of want to go back to strategize. So again, let's think about all the information that we've collected and looked at. Are there some lenders that we can engage with to better serve borrowers? And so we already talked about, like, we've been talking about getting the credit unions more involved with Take Root Milwaukee in particular, because we think it's a great network. And we see them in our top 10 list, right? So, let's talk with them and think about and help bring them into, like, sort of share their experience. Like, what are they hearing? That's some of the, Bethany talked about this, but hearing our mortgage lenders and our home buying counseling agency staff talk about, the work that they do every day with people really helps us think about broader strategies on how we can help meet gaps. And so, Irma had put a comment in earlier too, are there other product gaps that we can advocate for lender-based solutions? So, we have some examples. For many years, we've been talking about the need for home improvement products that are accessible and don't have a lot of requirements in terms of things like CIBC and Great Midwest Bank have good products that work well for a lot of people who traditionally can't get maybe, let's say, a regular home equity loan or something like that. US Bank, North Shore, PureMax, and Great Midwest have all also filled a gap in the acquire rehab space. So this gets to our older housing stock and older homes that we all love so much, but need a lot of TLC. Some of them have been loved a little too much, need some more investment. So that's another way that we can think about strategies. Portfolio products, so what lenders have some of those products that serve the low to moderate income market really well. And let's think about how we can reach those borrowers and then also work with our partners on the ground in terms of reaching borrowers of color, right? And then the other side of this, there are some new homeownership program investments that are going to be put forward in the city in particular. And so, like down payment assistance, these things that we know work. How do we make sure that our non-white residents who are interested in buying a home know about these and are, at the table, like that issue of access? And so how can we make gains in closing the disparity gap? I'm really sad I see my typo there. I'll have to change that. And so this is a little bit where we end, but where we actually start the work, if you will. We end the webinar, but start the work. And so our next step is really to sort of plan the series, right? It's a big issue. We put a lot of information in here. And so we want to continue to lead this discussion. So the education advocacy work group, which normally plans these kinds of what we call roundtables, they're going to continue to do that in partnership with the economic recovery work group. And so our topics are listed there. And this is where, the chat that you guys, the questions you've had have really informed. But the next one we want to do is on these lending disparity reports. That kind of goes back into, some of the earlier comments about, what do we actually do about some of these disparities we see? And until we know what that looks like, it's kind of hard to come up with some good strategies. Could we go into a deeper dive into best practices for lenders? Take Root Milwaukee has this, what they're calling this Future Homebuyer Initiative, but it's this ongoing conversation within the network about what can we do to help people in the pipeline earlier? So that's that conversation around people who maybe have thought about buying a home, but just haven't taken the plunge, or say they have credit and financial issues and don't know where to start, right? So we want to think about some of those ideas. We started that earlier this year, but then COVID-19 hit, kind of, we put that on hold, but it's something we want to really pick up and use that initiative to kind of advance some of these innovative ideas. And then we could do one on just the impacts of COVID-19. We talked a little bit about that, but we could think about as more information gets released around the impact this has had on household finances and what this might look like for people buying homes, and then particularly the disparities along racial and ethnicity lines. That's something we can keep our eye on too. I also added in this sort of thinking around the $15 wage and wages, increases in wages, and how that could potentially impact income and people's ability to buy a home and make that investment. And so other ideas that people have, really please share those and let us know. And we kind of want to use that to build in some of the planning for these upcoming sessions. The last thing, so I'm going to actually show next. This is the lending disparity profile report that Bethany can run through the lending patterns database. It's like a sample report. We actually had looked at this a little bit and then realized there was a lot here that we could talk about. So that's why we are going to do that in an upcoming webinar. But you see, this is the 2019 snapshot for all lenders in the county. And you see the originations, the denials, purchase loans. And so we would spend a webinar unpacking this a little bit, like what does this tell us? And so that's just a sample, but if for other things, other ideas, we really are all ears. And the goal ultimately is to come out with some things that we're doing as a group to actually make sure that, you know, particularly African American and Hispanic borrowers in our community are able to access credit and buy homes and, you know, do all the things that, you know, we know that help build wealth in our community. So I'm going to pause real quick. I'm going to go to the next, this is really our thank you for joining us slide, but see just Joanna, if there's anybody else in chat or Q&A.
Yes. Raymond Monk, I believe it's Pastor Monk. Will participants receive a copy of the PowerPoint? Yes, we will do a follow-up
Yes.
and recap, and you will get a copy of the presentation. Lisa is asking, is the lending disparity profile available for smaller geographies?
Yes, good question. Thank you for asking that. So I can run reports for geographies as small as one census tract or a group of census tracts or any city in the state of Wisconsin or any county in the state of Wisconsin, any MSA in the state of Wisconsin, or the state as a whole. That's geography wise. They also can be run by race and ethnicity, by gender, by the income of the borrower, you know, the income category of the borrower, not the specific income, but the, you know, low income, moderate income, median income, or high income, or the income level of the census tract, the predominant income level of the census tract in which the home is located. So that, and so just to give you an example, we could look at loans to African American women in one census tract who received a high cost subprime loan for home improvement during any given year, and all of this data is by year. So it's you know, it's a conglomeration of all of the information that was submitted to the FFIEC, the federal government, during each year.
Right. And one thing to note too is the HMDA data, it has been released a little earlier, but it generally comes out mid-year now for the previous year. So you saw at that report at the top, it said, I think June 24th. I'm not sure if that's when you ran it, Bethany, but actually, no, it's the date up here. Yeah.
Yeah.
Oh,
I don't know why they put that in, because it's really misleading. It says 2019 snapshot, but it's really all of the data for 2019.
right.
I don't have a way to take that off of the report when I put in the parameters.
Right. Usually the HMDA data for the previous year is released. It used to be in September, but it's gotten a little earlier every year. So
Yeah.
the last 2 years, which is why we do this kind of later in the year. So yes, we'll send out a link to the recording, the slides, and then I'm also going to show you guys, this is the actual top 30 spreadsheet that we created. So, you know, this is a sample, this is Milwaukee counties, but we'll create a shareable Excel file for you that you can use. And so you can do these sorts, you know, by purchase, by refinance, you'll see all the names there. The reports that come out of lending pattern, basically, like she said, it's the lenders who have to report based on the volume of loans they did. And like, there's pages and pages for some of these where it's like they made one purchase loan, but they made like 10 refi loans or something. Yeah, it's like everybody you can find. And then you see some of the comparisons to the all lender, all loans made, and then this as a group and that kind of a thing. So this will also go out along with the slides and things like that. So that brings us to the end. I'm going to stop sharing now. And just say thank you for joining us this morning. We are ending right on time, which I think is a miracle because